All right, today we're going to tear into a recent analyst report from Morningstar, and we're looking at a big one of Canada's financial heavyweights, the Bank of Montreal, BMO. We're going to really deconstruct what's going on. We'll look at their performance, what their strategy is, and of course, what the analyst's final call is on the stock. So here's what we've got on tap. First, we'll check out BMO's latest report card. Then, we'll get a handle on its main business up in Canada and break down this idea of an economic moat. After that, it's all about their huge gamble in the US. We'll look at the headwinds they're facing, and then finally, see what the analyst thinks the bank is actually worth. All right, first things first, let's see how the bank actually did in its latest performance review. So let's get right into it. The report kicks off by calling the results okay. I mean, come on, when an analyst just says okay, you know that's not exactly a glowing review, right? It's kind of polite, but it's also a huge signal that there's something more going on here. It basically means, yeah, it wasn't a disaster, but it wasn't anything to write home about either. And this is where we see what okay actually looks like in numbers. We're looking at return on equity, or ROE, which is just a fancy way of saying how profitable the bank is. BMO's actual number was 11.3%. Now, that's not terrible, but here's the kicker. Their own target is 15%, so they're falling pretty short of where they want to be. And believe me, this gap, it's pretty much the core of the whole analyst report. Okay, so why is there a gap? To really get that, you've got to understand the business. And BMO's business is basically a tale of two very different countries. Back home in Canada, BMO is an absolute giant. We're talking the fourth largest bank in the country and part of what they call the Big Six. And get this, those six banks, they control almost 90% of all the banking deposits in Canada. That's just a staggering amount of market power concentrated in a few hands. And this chart really tells the other half of the story. Canada is their home base, for sure, but a huge piece of the pie, a full 40% of their earnings, is now coming from the US. So you can't just think of BMO as a Canadian bank anymore. They're a major North American force. And this split personality? Well, it's where you find both their biggest strengths and their biggest headaches. So you've got this massive, powerful business in Canada. How do they protect it? Well, to figure that out, we've got to talk about a key idea that analysts love to use, the economic moat. It's all about how a company defends itself. What the heck is an economic moat? Well, just picture a big old castle. The moat is that ditch full of water around it, right? It makes it super hard for anyone to attack. In the business world, a moat does the exact same thing. It's a protective barrier that keeps competitors away from a company's profits and its customers. Morningstar actually uses this whole moat idea to rate how well defended a company is. And for BMO, the analyst says it has a narrow moat. What that tells us is, yeah, they've got some pretty solid advantages, but it's not like they're completely unbeatable. Competitors could, in theory, get across. So where does BMO's moat come from? It's really two main things. First, they have cost advantages. And second, switching costs. You know, because that Canadian market is what you'd call an oligopoly. It's dominated by the Big Six. There isn't a ton of price competition. And honestly, it's just a pain for people to move all their accounts, so they just don't. They're kind of locked in. And here's the bottom line on this. BMO's Canadian business is basically operating inside a fortress. There are these huge barriers to entry, thanks to regulations, that just keep new competitors out. And the result? It's an unbelievably stable and profitable base for the whole bank. But, okay, if your Canadian fortress is already built and secure, where do you go for growth? Well, for BMO, the answer, and it's a huge gamble, is to look south of the border. And they made a massive move back in early 2023. They bought Bank of the West. And this wasn't some tiny little acquisition. No way. This was a major strategic power play designed to massively boost their footprint in key U.S. states like California. Honestly, this one deal is what the entire analyst report really hinges on. And this right here, it's the whole story in a nutshell, the good and the bad. The good part? BMO has been absolutely amazing at cutting costs from this new bank. They actually saved more money than they even planned to. But the bad part? Getting the new business to actually grow has been a real struggle. Revenue has kind of stalled out, and they've had to delay their big synergy goals by a whole year. And you can see that challenge staring us right in the face with these numbers. Remember that overall ROE we talked about? Well, this is just for the US part of the business. It's sitting at only 8.1%, which is a long way from the 12% they're shooting for. This underperformance in the US is a huge drag on the whole company's result. So all this brings us to the bigger risks at play. BMO's big American bet isn't happening in a perfect world. Oh no, it's running straight into some pretty serious economic headwinds. The folks who are pessimistic about the stock, the bears, they're pointing to three big worries. First, they're seeing higher credit costs in U.S. commercial lending. Second, there's the chance that if the U.S. economy tips into a recession, those Bank of the West revenue targets could get pushed back even further. And third, and this is a big one, is the whole threat of trade fights between the U.S. and Canada. And this quote, straight from the report, doesn't pull any punches. It really shows you how everything's connected. A trade war wouldn't just be some headline on the news. It could actually push the entire Canadian economy into a recession. And for BMO, that's a double whammy. You're talking slower growth and more loans going bad. Ouch. So, after all that, how does the analyst weigh everything? You've got this super stable, protected Canadian business on one side, and this risky but potentially high-reward U.S. expansion on the other. What's the final call? This table gets straight to the point. When this report came out, BMO's stock was trading around 177 Canadian dollars. But the analyst's fair value estimate, which is basically what they think the company is really worth, is way lower. We're talking $151. So the takeaway here is pretty clear. The analyst thinks the market is just a little too optimistic right now. Even with BMO's strengths, especially that great Canadian moat, it looks like the stock price has gotten a bit ahead of itself. It probably isn't fully accounting for all the risks and delays happening down in the U.S. Which leaves us with the million-dollar question for the Bank of Montreal, right? Its whole future is hanging in this delicate balance. Is this huge American gamble going to pay off and just launch their growth into the stratosphere, making the current stock price look smart? Or are the challenges in the U.S. and all those bigger economic risks just going to be too much to handle, reminding everyone why that safe, boring fortress back home was so valuable in the first place? The answer to that is going to write the next chapter for this Canadian giant.